What's up, everybody, and welcome back to the J&J Futures Bootcamp. Today is the first episode where we dive into technical analysis, so actual terms and things that you can learn or put on your chart. So today's topic is going to be liquidity, liquidity sweeps, and just overall what buy side and sell side liquidity are.
The market is a hive mind, as we know. It's a bunch of people placing orders, buy orders, sell orders, wherever they want. Back in the olden day, as we know, these orders would be physical copies, and they would go to the stock market and they would give it to a broker. But in a digital age, none of that exists. Orders are now placed online, so you can go to an app like Tradeovate or TradingView and press a buy or sell button by yourself. There's no middleman.
Liquidity is a term for an area or a price point where a lot of people are trying to have buy or sell orders be taken or put in. And those areas are also known in ICT terms as swing highs or swing lows.
Okay, so let's take a look at this chart right here. So I pulled up a little easy image. It's just like one line, a little chart graph thingy. You can see right here that the high points are called swing highs and the low points are called swing lows. And the market fluctuates. So we have these little kind of Z patterns right here. And then when we zoom out on the market, remove this, we can see that we have a graph right here. When we go to actual candlesticks, we see these moves. When we hit a low point, it is a swing low. So right here, this would be a swing low where it says NYAM. That would be a New York AM low. That is a sell side swing low. And then when we go up, these high points right here. So this says NYPM, which is New York PM. That is a New York PM high. That would be a swing high. And these are both areas of liquidity. So like I said, these are areas of liquidity, so these low and high points, and I'll show you how someone, for example, could place an order right there. So just go here, press buy, this little blue box, and then you could go to market limit or stop, upper limit, for example, and you just set an order at that certain price. So these areas of liquidity are where a lot of people have these orders, either buy or sell orders.
So the main reason why big moves happen at these points is because most of the market, over 90% of market movement is from bigger firms like hedge funds or market makers, Citadel, Goldman Sachs, firms like that. There are a lot of retail traders who may be in trades and place their stopping point or their take profit point at these swing highs or swing lows because there's significant supply and demand zones. So, because big firms know that, they are waiting for price to get to one of these swing highs or swing lows. And then when it does, they're taking all those orders that are in that space and then reversing price. Which is why, after we hit a significant swing high or swing low, we usually see price reverse to the other side.
So let's show you guys an example of a reversal. So let's look at this chart. We're on the 15-minute time frame. So look, we go up, up, up. We create a swing high right here. This is liquidity, an area of liquidity. Then we go back down, create a swing low. This is also another area of liquidity. Then we so price moves like this, whatever, chop, 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 and then it takes out liquidity at this point right here. This little candle wick takes it out. As soon as we take it out, see how we reverse up and start trending upwards. This is called a reversal. So this is very useful when we're trading ICT. When we see liquidity being taken out, it's a hint that the charts may be reversing.
So this taking of liquidity is what's called a liquidity sweep, and that's where those big firms, those market makers that we just discussed, are coming in. So this is what makes our trading a lot different than most retail traders. Is instead of trying to combat or fight the market makers or the hedge funds, we're just riding the wave that they create, and that wave almost always starts with some sort of taking of liquidity.
So once again, liquidity and taking out liquidity is the foundation of our strategy. And like this example right here, it's not just like a one-time thing. It happens all the time. So we're going to cover something called internal and external liquidity right here. But for example, we have internal liquidity right here. We take out this swing low, or not swing low, just an internal liquidity low, and we see this little move back up. Then we go back down, take out this low, and move back up. So this happens a lot in the market, but we base most of our trades off something called external liquidity. And once again, we're going to cover this right now, but this would be external liquidity and see this big move back up. So once again, liquidity sweeps happen all the time in the markets. It's just where to find them and where to know when to enter trades when liquidity gets taken.
So yeah, in conclusion, this is the kickoff to the technical analysis part of this boot camp. Liquidity basically sets up every trade that we take as a group in our Discord and that most ICT concept traders take in general. Liquidity is great for targeting places to put your take profit, your stop loss, entering trades, getting out of trades, etc. It's very, very important, and mastering liquidity and liquidity sweeps can really help you take that next step as a beginner trader.